Hi, everybody. Let me find the right format. This maybe? No, this one. Okay. Hi, everybody. This is the Physics of Bitcoin show. It's, I think I lost count. Do you remember which?
26.
26.
Yeah.
Episode 26. And we always give a little introduction. So basically, the idea is that both Stephen and I are PhD in astrophysics. In fact, today I saw a tweet by Elon Musk saying something about physics, how physics detects all the lies or something like that. And Saylor posted saying, "Hey, Bitcoin is physics." He wanted to use that tweet to make a point, and I responded, "Well, I say that since 12 years. I say that even much before Saylor said it." But so that is our point of view, that really to understand Bitcoin, you need to use this framework that is a framework of physics. And what is special about physics? We really care to understand things from ground up, right? We want to go to the foundations, to the minimal elements that you need to understand a phenomenon around you. And of course, is also the idea of using data. It's all data driven. It's a framework of understanding. In the end, you can make all kind of theoretical model. If the model doesn't correspond to reality, then it should be rejected. And there are also a lot of analogies from the physics world that allow us to understand all kind of different systems, including financial system, including systems that are driven by human emotions and human action. I know that goes against the understanding of certain people. I don't believe that this mathematics applies to human beings, but there is plenty of evidence. We mention all the time this book Scale, for example, by Jeffrey West, where he discusses the application of physics concept to understand cities, for example, that are human creation. And this actually is very relevant to the topic of this evening, where Stephen will discuss how this analogy with how cities grow and develop actually applies to Bitcoin, or at least topics related to Bitcoin, the Bitcoin ecosystem. So this is our particular approach. It's a different approach from other analysts or shows that you can see about Bitcoin, and I think it's valuable. It's a little intense, so my suggestion is we record these videos. You can watch them on X, but we also record them on YouTube. So go back to some of these shows. They are all listed on YouTube because we cover many relevant topics. For example, at a certain point, some months ago, Stephen covered the topic of quantum computing and the threat of quantum computing for Bitcoin. And I think it's one of the best. I think it was episode 5, by the way. If you guys want to go and watch it, it's one of the best presentation I ever seen about this particular topic. And Stephen give us, and I don't think it needs to be updated, right, in terms of the new discoveries.
No, nothing's changed, from the general picture yet.
Yeah. So, if you're worried about quantum computing, please watch that episode because you have a real physicist. I didn't see yet anybody discussing this topic with the type of background that Stephen has, because he's kind of an expert in this particular field, and his presentation is excellent. So some of these episodes require you to kind of follow a little bit what we are saying, maybe stopping the video, trying to understand better the arguments discussed. But I think they are very, very important topics, and they give you an understanding of Bitcoin that you will not get anywhere else. So this is our agenda in having this show. We have also an overall dream and direction that is we are building we are organizing this institute. Is called the Bitcoin Scientific Research Institute, that hopefully in the next few months will be realized, and it will start to do a lot of activities, like eventually organizing conferences, for example. This will be alpha driven conferences, or meaning driven conferences, instead of being basically cheerleading for Bitcoin, that has its place. But sometime in these conferences you don't see a lot of content, and this is what we would like to do. But many other initiatives that we will discuss as they develop. Anyway, so this is the introduction. I don't know if you want to add.
Yeah, I do. I just want to pick up on something you alluded to before about the nature of physics. With physics, we see both fundamental phenomena and we see emergent phenomena. And the universe is layered. There are many layers. And you start, at particle physics at the bottom, and then you get to atomic physics and molecular physics, and then you get into the domain of chemistry and organic chemistry, and you go all the way up the stack. And eventually you have human beings. And you have both fundamental sorts of behaviors and emergent behaviors. And physics can apply to both the fundamental and the emergent. And with cities and with Bitcoin, which are social phenomena, what you're seeing is emergent behavior. But underneath it all is physics. If you've ever heard the expression, it's a joke about, an astronomer was talking about the Big Bang in cosmology, and a lady said, yeah, what's below that? What's below that? And she said, lady in the audience says, it's turtles all the way down. Well, our position is it's physics all the way down, and everything's layered above that. And then we get more and more complexity, and we get emergent behavior. And that's relevant to the topic today, which is the analogy between cities and Bitcoin and these treasury companies that have become so important of late.
Fantastic.
Shall I start sharing the slides?
Yes. First, the agenda. And, you have an agenda, right?
Yeah. Okay. So title is Can Companies Become Like Cities? And the title is, this is episode 26. Okay. So my hypothesis here is that companies can now choose. They can choose between exponential growth, which is the world they've been living in, and that exponential works in both directions, up and down, or they can choose more stable long-term power law growth. So what I want to do today is first kind of tie up some loose ends on the approximate entropy discussion from last week. I showed 104-week moving averages for approximate entropy. And a question also came up about why is there a rising trend? So I want to show the 208-week and also particularly address the rising trend with what I think is an explanation, and I think Gio generally agrees with that. Then I'll get into the heart of it, which is the companies are exponential. That's how they behave in terms of their lifetimes. They sort of decay, over a decade or two. And Bitcoin treasury companies have the opportunity to reinvent themselves and move their behavior and their lifetimes to be more lindy towards a power law nature, to be more city-like. And we know that cities can be much longer lived than companies. And so I'll look at where are we now in this process, and which companies are doing that or poised to do that amongst the top few. And I'll close with a section on the log periodic power law bubble models for both Bitcoin updating and 3 of the treasury companies, and what those are saying about behavior later this year. So first, on the approximate entropy section, this is a review. So if you were here last week, you saw this, but for people who were not here last week, what approximate entropy does is it's based on Shannon entropy, which is the entropy for information. It's in that spirit, but it's a little bit different kind of formula. It's designed for relatively short data series, such as seen in physiology applications, as well as in finance and other places. And it's relatively new. It dates from 1991, Steve Pincus. And so what it does is it takes a bunch of short vectors within the series of length 2 or 3 or 4, and then it looks how close they are from one to the next. And it's particularly looking for the ones that are quite close, that is, close to within a fraction of a standard deviation, and a typical filter is 20% of the standard deviation of the overall set. And that's the summary of the formula there. You don't need to worry about that too much, but to get the approximate entropy, you need to look at one order like vectors 2, and then the next higher order vectors 3, and it's the difference because it drops off as you go to higher order. Okay. So last week we showed 104-week, and this week it's 208-week averages. And we're looking at 3 series: price, returns, these are weekly returns, and the residuals from the power law. So the returns, and these are all logarithmic quantities. So the returns are just the log of the ratio of price one week to the next. And those are the orange line. The blue line is the log of price. Entropy determined from the log of price series. The orange line is determined from the log of returns, as I just described. And then the green line is the residuals, which are first detrended by the power law. And this chart is for the shortest vectors, m equals 2. And what we see is that we get the green and the blue aligning well. That's log price and residuals in 2017, in 2021, and in 2024. You know, the first 2 are major peaks, and 2024 was kind of a mini bubble that we had right at the end of the year. And the price history is given on the gray line, and you can see that they basically are kind of predictors, or they're warning you about a peak that's coming down the road, and they lead by a few months. The other thing to notice here, except for the very latest one, that mini bubble lined up pretty well with the actual peak, and the orange one kind of fits as well. And notice also that the entropy is rising. It's true for the residual power law detrended, but it's even more true for the entropy calculated from the price, that it rises from about 0.2 at the base up to, you know, the 0.5 level. The lower the approximate entropy is, the more ordered the process is. So there's some increase in the disorderliness or the entropy, and that means that there's more information, it's more complex to describe, there could be more variability, particularly on the short-term timescales, because this method is looking at short-term. So this next one is just the same thing, but a higher order level, the m equals 3. You expect the values to be lower here, and they are. You see the same alignment with the blue line and the green lines for the price and the residuals, particularly at 2017 and 2024, and leading the price peaks either by something up to 8 or 9 months in one case, and just a couple of months in the other case. It's less obvious what's going on at 2021. There's not very good alignment there. And the log return line is not very helpful in terms of being predictive. That's the orange one. But again, we see this rising price entropy from the 0.2 area up to the 0.5. So the question we had last week was, what's going on there? Why is price entropy trending up? Okay, a little bit of background. We also know that the bubble strength has come down roughly as the reciprocal of Bitcoin's age. So we seem to have a situation with fewer and weaker bubbles, less herding behavior, more hedging that's bringing down the volatility and the bubble sizes. But also we're seeing less repeatability in the short patterns. That is, their entropy is rising. If their entropy is low, it would suggest high repeatability. So what's gone on, and what do we think is the reason? Well, in part, there are many more players in different categories, and they approach the market with different strategies. And the investment capital that's coming in has a longer time horizon in general. This is less true for exchanges and Bitcoin mining companies that have been around for a long time. And Bitcoin mining companies, have to sell most of their production usually. The ETFs may be a little more stability, but they're kind of easy to buy and sell as well. But more so in terms of longer time horizon are the pension and sovereign funds, the family offices and the hedge funds, and now these important Bitcoin treasury companies and even state and national governments that are starting to accumulate Bitcoin. So one could say by analogy that turbulent surface has moved from these highly localized surge or storm waves to more choppy seas over a larger area. And that's appropriate as the ocean of invested capital has grown and become deeper. So that's it for entropy. And let's move on to cities versus companies. And I'm quoting Jeffrey West, the physicist that Giovanni just referred to and the author of Scale. And he's at the Santa Fe Institute. He was president there for a while. And they do, interesting research in nonlinear systems, for example. He says it's hard to kill a city, but easy to kill a company. And the mean life of companies is 10 years. Cities are the crucible of civilization, the major sources of innovation and wealth creation. Athens has been around for 5,000 years. Rome has been around for 2,700 years. It's had its ups and downs, but it has endured. Detroit also has had its ups and downs, but is endured, as something that's a relatively new city for over 300 years. On the other hand, Angkor, which is Angkor Wat in Cambodia, made it to 600 years and then it collapsed. But it had a pretty good population scale. I think it was close to 1 million for that area at the peak. Orders of magnitude, a small town might have a lifetime of 100 years, and that would be of scale 10,000 people. And a large city, it might be 1,000 years, and that would be a scale like 1 million people or more. And you can see there's kind of a rough square root relationship going on there. Maybe a power law of some sort. These are the findings of Jeffrey West and his co-authors. They published, I think it was in 2005, The Mortality of Companies. And these are charts from their paper. And if you look in the right-hand chart, it's a log linear scale, and it's a straight line. That's an exponential. And it's e to the minus 0.1 of age. So when the age is 10, it's e to the minus 1, basically. And you're falling a factor of e, which is a factor of 2.78, right? So when you work through all of that, the exponential lifetime averages out to be 10 and a half years. Companies can be acquired, they can go bankrupt, they can spin out, divisions, they can go private. A lot of different things can happen to terminate a company as a publicly traded entity. And these were 25,000 publicly traded North American companies and 60 years of data and many different industries. You can see the industries are color coded and, they behave slightly different, but overall they're still following the exponential fall off. Companies scale sublinearly internally, and they're subject to various external pressures. And then I would also comment that altcoins like Ethereum and Sol are more like companies or consortia. They don't really have this option to be like cities. Bitcoin today, you can say, is a decentralized megalopolis, and it's a scale of $2 trillion. Its GDP, in quotes, is above 800 billion, and that's the annual new value that's created, the market cap value increase if you're on the power law trend right now. And next year, it'll be higher. It'll be above $1 trillion. So the GDP is growing quickly due to compounding, even though the price growth is slowing. The absolute value is rising significantly. There are today only 7 cities with a larger GDP than 800 billion: New York, Tokyo, LA, the San Francisco Bay Area, Seoul, Paris, Chicago. So Bitcoin is already a very major city in that sense. And there are many out there have talked about citadels, and they're being built, and they're part of the overall megalopolis, which is a meta network in itself of power laws, interacting power laws. And there are at least 10 or 12, subnets involved in Bitcoin. So ChatGPT agrees with the analogy that a metaphor works well to describe its vast, interconnected, influential ecosystem. And that's a citadel in Italy that didn't reach the scale of a city. It was a small town, right? Now, I just want to contrast with Ethereum because there was just an announcement this week that
I'm going to buy that Citadel one of these days.
yeah, it's going to be the headquarters for the Bitcoin Scientific Research Institute.
Absolutely.
Yes. So there was just an announcement this week. This very famed investor, who actually is pro Bitcoin, Fundstrat's Tom Lee, is going to be chairman of this new, quote unquote treasury company. They're going to raise $250 million. They think they can become the MicroStrategy of Ethereum. Well, I think the whole premise is flawed because Ethereum is more like a consortium of companies. So there's little chance of cityness. Doesn't mean they can't make some money, but it doesn't have the same fundamental characteristics underpinning it. And I asked ChatGPT to say which one of these is the winner from a Lindy, and that's the lower chart. Age, protocol stability, regulatory clarity, cultural enrichment, technological breadth. Okay, Ethereum wants to do everything, so it's got breadth. But clearly, Bitcoin is far more Lindy, both in the nature of it and in the track record. And then I said to Chat, well, you missed something really important, which is proof of work versus proof of stake. And so that's the upper chart, the consensus type. And of course, Bitcoin wins there in all categories. Ethereum is not anchored in physical reality. It's less resistant to political capture. It doesn't have long-term decentralization, and it's unproven under stress. So let's get on to the Bitcoin treasury companies that have the potential to becoming like cities. Strategy just this week has checked all the boxes for inclusion in the S&P 500. So that's certainly one milestone. It has to be formally approved, but they check these 7 boxes. And as treasury companies add Bitcoin to their balance sheets, they're adding power law behavior, and they're adding stability, and they're adding Lindy persistence and future life because that's what Bitcoin has. As you probably know, there are over 100 companies around the globe that are now building their Bitcoin reserves or citadels. So they can start securing their future. They can build walls of security with Bitcoin, and they are the starting point for something that might become more like a city over time. Master today, with 114 billion of market cap, is similar to an American city in terms of wealth if the American city has a population of 400 to 450,000. So it's a decent medium-sized city in that sense. Bitcoin, it's up there just below those top 7 in the world. And if you take the San Francisco Bay Area and sort of cut it in half and include San Francisco and the peninsula, but not San Jose and Oakland, then it's about half of the Bay Area. And Bitcoin treasury companies have now become more important than ETFs in terms of the amount of Bitcoin that they're adding. And this has been true now for 3 quarters in a row. So they've grown their Bitcoin balance, I guess in the last quarter, 18%. And the ETFs, or maybe it was over this, sorry, it was probably over this whole, not quite sure whether that's 1 quarter or 3. I think it's probably just the latest quarter. And ETF showed an 8% increase. And here are the top 100 companies. This, of course, needs to be updated nearly every day. This is from a couple of weeks ago. It's well over 800,000 in total, dominated by strategy, just shy of 600,000. I think they're at 597 now. So will Bitcoin treasury companies evolve to be like cities? On the left, we have a charts for the probability distributions of cities in Italy. And what we see is a paper Sanchirico et al. From a few years ago. We can see that they follow power laws once you get to a certain level. Once the city size is 10,000. So if you look at the left-hand side of their chart, you see this curvature. It's a log chart, both in the probability of a certain population and in the population size. So straight line is power law. But if they're too small, you don't manifest the power law. So they found that kicks in at around 10,000. So that's the right-hand side of their chart. And they show two different power laws. One is for city size, and that's the black dots in line. And the other is for the probability of a person living in a larger city. And of course, there are more people in larger cities. So the power law is one steeper, less steep. It's one more shallow than the distribution of the probability for city size. So they're both pretty good straight lines. One's 2.4, the other's 1.5. So different by one, within the errors. And I previously showed the chart on the right. This is not probability, it's rank ordering, but it's related, and it also should manifest a power law. And we see the same sort of phenomena. Now, I excluded master because it's such an outlier. So this has the next 99, and it's a power law for the first about 16 or so companies. And the power law is -1. This again is a log chart. So it's log Bitcoin holdings on the y-axis, it's log of rank on the x-axis, going from 1 to 100. And if it's -1, that's Zipf's law. So it's very close to -1. And so that applies to the leaders. But the rest of them are like these small cities in Italy. They're like the cities, below 10,000 or 5,000 people. They haven't caught up. They are trying to catch up, and they're going to have a very fierce competition between them and jockeying to try and get up to Zipf's law. Not all cities make it to large size, right? And
will not be better. Can you go back to that slide?
Yeah.
To make a, I mean, it doesn't matter, but to make a one-to-one comparison, probably will be better to invert the X and Y.
Yeah, the probability. Axis. Well, in fact,
to have a rank on the Y-axis and the holding on the X-axis. So it's comparing when it's more similar to the one from the paper, right? Because
I see. Just reverse the axes.
Yeah, it will curve like this.
Yeah, I can do that. The other thing is
usually it's the tail that becomes an exponential.
Right.
I mean, it becomes a power law, right? You have so it will be better to do it the other way around.
Right.
And rank usually in the Zipf law is the y-axis. It doesn't matter, but it will be easier to compare with two graphs.
Yep. Yeah. Good suggestion. Okay, and then this is the Bitcoin treasury race, and I've calibrated it for you. So, we've got at the top strategy trying to get to 1 million, and 1 million would be about 100 billion asset value. And then you go down by kind of two grid lines, and it's 10,000, and that's about 1 billion asset value, right, at current prices. And an American small city of 10,000 would be something like 3 to 4 billion of private wealth. And in fact, the equivalent median and mean wealth for US adults is 2.5 Bitcoin for median and 5 Bitcoin for mean. So that gives you the scale of how you can make this comparison. And this chart is from microstrategist.com. They have a lot of nice charts, so you might want to give them a look. So if you say, to get to be a small city today, you want to get above 1 billion asset value, there are really only 5 companies that right now are in the running. However, 2 years from now, their Bitcoin value will double probably on the power law, even if they don't add any Bitcoin, right? So it's going to get easier with time. We're in early days yet, and we're going to have to see how this all develops.
And here, wealth of a U.S. Citizen means what? Their real estate and
Yeah, it's everything. It's their net real estate and stock holdings and bank accounts, whatever, businesses. So it's like a quarter million is median, and 500,000 is the mean in dollar terms, roughly. Okay, and this is a list of all the companies that have more than 3,000 Bitcoin on their balance sheets. You can't really consider all of these as Bitcoin treasury companies because several of them are mining companies. Others have quite diversified businesses. So really, it's just the 5 that are bolded that are best positioned as Bitcoin treasury companies. You see Strategy, Metaplanet, Galaxy is a little questionable because they have diverse holdings. Similar Scientific and Boya Interactive on this one. Mara, Riot, CleanSpark, Hut 8 are all mining companies, and they may or may not, and they've got different ideas about this. They may or may not become more like Bitcoin treasury companies. Mara seems to want to. Right now, it's 88% of their market cap, and yet it's not reflected in their stock price. They don't have any multiple. Their stock's been flat 4 years, so that one's an interesting. The third one, CEP, is 21. Jack Mahler's associated with that. They're too new. We don't have a history there, but that's what they want to be. They're clearly designed to be a Bitcoin treasury company. So that one we should see entering more and more. But what I did is I looked at their price history, and I did power law regression since the date they first held Bitcoin on their balance sheet. But the regression zero date is when Bitcoin started, January 2009, because what they're doing is they're jumping on top of an existing Bitcoin power law relationship. And what I found was that 3 of them have power law indices around 4 to 6. The latest for Strategy is 6.08, for Galaxy 4.11, for Similar Scientific 5.18. 2 of them, Metaplanet and Boya, have very, very high power law indices, which we would not expect to be sustained over time. And in fact, if you do them from when their own first date was, then you get low power laws down like 2, and they're going to end up somewhere in the geometric mean probably. But we'll have to see how that shakes out. The R squareds are okay. It's 0.42 for Master and 0.44 for Galaxy, 0.62 for Metaplanet, 0.8 for Boya and for Fnatic. Similar, it's only 0.1. They're kind of undervalued, it appears. Whoops, we went 2. So this one just shows on the y-axis the power law index, which is pretty discordant for 2 of these, but it's in the general space one would expect, close to 5 or 6 for the other 3. And as they evolve, they'll acquire more Bitcoin. Their MNAV, which is the market cap to net asset value ratio, will moderate. It won't stay probably above 5. It'll come down towards the 3 and below. And we expect that they'll start manifesting power law price behavior. And that, one could say, is they're starting to acquire the characteristics of a city, since cities manifest power law price behavior. Sorry,
so
power law, GDP, and output behavior.
So before you go to this topic, right, with this slightly different topic, I want to congratulate with you on this incredible idea. I immediately understood what you were trying to show, and it's a big deal because it's a really the punchline. Everybody, I really suggest everybody to watch this video. We always recommend. It's called. You can Google it. Google. If you guys want to see a fantastic explanation of the relevance of power laws in the world, it's a only 10 minutes video, probably less than that. It's called The Surprising Math of Cities and Corporations by this physicist, Jeffrey West. And it's one of the main punchline of that entire lecture is exactly what Stephen explained, that the data show that cities grow like power laws, all the different parameters, many different essential parameters, from how fast a city grows, the GDP of a city, the number of patents in a city, the number of libraries, how fast somebody walks in a city, also some negative property like the number of crimes. Everything that is important for a city grows like a power law. And the result, will be and I think Stephen showed a graph about how likely is the survival rate of a city relatively to its size. That looks also like a power law. That is another interesting thing to explore. But the fact that one can make a case, and if you read the book that goes a little bit more in details, it's clear why cities live for a long time. They are more flexible, they are more resilient, etc. And this is due to these power law properties. And then you have corporations, that is another creation of human beings, right? That they don't live long lives. Most of them die within a century at most, and most of them actually die within a decade. And that is so interesting idea that by adopting Bitcoin, now a corporation has a chance to become this other entity that human beings create, that are more stable, that are more flexible, we can resist more to crisis. That is, basically becoming like a power law. And so it's a genius. It's a genius idea. I really love it that you had this intuition.
Yeah, well, it's actually not a new idea. Saylor realized it. Saylor knew that his company was stuck, that it couldn't grow, that he couldn't compete with the larger companies, that he was too late to AI. And he had this hurdle of 10, 15, really 15% that he couldn't meet. And he felt like MicroStrategy was on a slow boat to death, and that he had to change. And so he did it out of desperation. And he realized that Bitcoin was going to allow him to build something that would be viable for decades longer.
Yeah,
And so,
yeah. Go ahead. So finish, please.
well, I just say he intuitively understood this.
Right. So that is
Yeah.
true. So Sailors has a lot of good intuitions. This is why he's a business person. You have to have that level of intuition, and he brings to actions this intuition. But then he tries to explain this concept, and I think besides some general statements that maybe they can be valid or not, he doesn't do always a good job in explaining the math and the logic behind, right? It's kind of pep talks. They are like cheerleading. And what we are trying to do is actually to give mathematical explanations and logic, and bring logic and data to actually, to these intuitions. We are doing the best. Sailors actually should hire us or should donate to the institute, right?
He should. He hasn't really grokked the power law yet.
No, exactly. But the power law explains everything, even this why he made this choice, and the fact that he mentioned cities all the time. He never mentioned MicroStrategy being a city, but now we gave him an argument to do that. And it's amazing. So the genius of your intuition is to actually put it in this context, right? That it's a way for a company to escape this fate that basically all the companies have, that is collapsing eventually, and instead of making strategy something that could last maybe as long as Bitcoin, or for sure a long period of time. Now, that is also give us another intuition and advice. There are a lot of people that love to see these God candles appearing in strategy, right, or other companies that are adopting Bitcoin, and explode, and becoming exponential. And it happened a little bit for a short while at the end of the last year, when a lot of people were pushing, were doing a lot of um, trading, with a very high leverage, and say there a lot of speculation.
You
And I
see it in
was,
the chart. You see it in
and
the
yeah,
chart here.
exactly, right. And I was warning
Yeah.
everybody to be careful, because it will not last, and actually was not good thing for strategy itself. And then it corrected itself, and now if you look at, actually I adjusted that jump. I included in my model. I adjust for that, and then it does look like an overall power law if you compensate for that jump. It was a jump of almost a factor of 2, in performance relatively to the power law, in a very, very short amount of time. So actually, again, you want a strategy to have a little bit of leverage relatively to Bitcoin, but not to leave this power law behavior underlying Bitcoin itself. You just want a hyper power law, a higher exponent, but you don't want to become an exponential. You don't want for MicroStrategy to be an exponential.
Okay.
It's a very important concept.
And we will look at, we'll look at that chart in a moment. And this is the log periodic power law behavior of Bitcoin. This is the model developed by Didier Sornet, who started out as a geophysicist, has applied this kind of modeling for everything from earthquakes to financial price series. This is weekly data for 2 years, fit to the model. And right now, it's has a critical time at August 24th. You can see 3 waves. So there's an initial long wave that's mostly in 2024 and centered around, April Q2 of 2024. Then you see another wave, which was the end of the year wave. And then now you see, that bubbled up in Q2 is the third one. And then hopefully we're starting into the 4th wave here at the early July, and that could take us up towards 120,000 according to this fit. Now, these things are sensitive, and you have to kind of play with them and keep updating them. And, it's not going to keep predicting the same endpoint a month from now that it does now. So understand that, because they have so many parameters. I've got 7 parameters. Right now, the estimated price 2 weeks before the critical point, it gets difficult to estimate it right at the critical point, is 124,000. Very high R squared. It's a 94% R squared. So that's quite interesting. And the uncertainty is only around $6,000, which is small for the model uncertainty. So that's Bitcoin. Now let's look at strategy. Here it has the critical time, which is the last of the 7 parameters on the left, at October 20th. The other parameter that's worth interesting to look at is omega, which is the 5th parameter, 10.85. That tells you roughly how many waves you're going to have.
So these critical times, just to explain to people that are not familiar with this model.
Yeah. Let me refresh people or tell people who haven't been on before. Basically, you have a power law trend, and then you have waves on top of that. So the parameters A and B and M tell you the level and the slope and how fast the power law trend is. And then the waves are characterized by the C parameter and the omega parameter, which is the frequency, and it tells you how fast the waves are coming. And the waves are distributed in time, not linearly, but logarithmically, and they get shorter and shorter. And you see it on the graph here. You've got a very slow wave, a little bit faster, even faster, 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 faster. That's the omega, is how do they get faster? Then the critical time is it all goes like vertical, and the idea is that, it becomes unstable, and then that's when you have a crash and you have the end of your bubble. So this one is saying 120 weeks from the start date, which here was, 2 years back. And so that puts it into October of this year. And a lot of waves because omega's almost 11. And we see 1, 2, 3, and the fourth one could be forming here. And then if you try to estimate a couple of weeks before, because it gets very hard, is the dash line, the projection gets very steep, the orange line. It goes up toward 1,000, but 2 weeks before it's about 700.
Something is going to happen, right? With
Right.
probably a price correction of some kind, or usually a drastic price correction. So basically, that is what this meant for critical time, right? And they can go
Right.
up or down, but this is it probably is a correction down, right? Given that it seems that we are going higher and higher, and so there will be a correction down. It's basically a mini bubble, a mini.
Yeah. Well, this is a real bubble. The general idea is that the risk of a crash becomes higher and higher as time goes on, and certainly as price gets steeper and steeper. That's the broad idea here, and you have this kind of struggle between the people who are playing momentum and the traders, and people that are hurting, and then people are looking at things from a more fundamental standpoint and either selling towards the tops, which we know the whales do, or even shorting.
Yeah.
Okay, so that's a pretty good fit for that one. And then the next one is Similar Scientific. It's not a very good fit. R squared is 0.2. Omega is also high at 10. The critical time, it says at the end of this month, but it's hard to put much stock into this because of so much difference between the model. And similar, their business, they've got a positive cash flow, profitable business from their, bioengineered products. So it's a little bit more complicated to analyze them. But it does look undervalued. And then the next one and the last one in this set is Metaplanet, the Japanese company. And there's a ADR that trades in New York, but there's only daily data for that since November of last year, whereas they adopted their strategy over a year ago in April 2024. So if I run just the data from the New York data, it has a peak now and a value around $16 for the peak, which is not much different from today's price. So, a little, I think it's at 11 or 12. I'm not sure exactly right now. And then the chart is Tokyo yen. And we see, since I was unable to download this data. It wasn't downloadable from the sources I went to, because it trades in Tokyo, but you can see the three peaks. There's 3 peaks since April 2024. And if you just fit those with the idea that the time intervals are spaced logarithmically, then you get a ratio of 0.56. And the equation for that is just the size of the interval, the nth interval depends on the size of the first interval times this ratio to a power n as you add more and more intervals. And this ratio, lambda term, is always less than 1. So that suggests that you could have 3 more peaks in August, September, October, and the omega was 7 on the other one. So it's reasonable to expect several more peaks. And so maybe we'll see a peak in October timeframe. But actually doing that and estimating and converting yen back to dollars, it doesn't change the price very much. Here's a summary of those 4, Bitcoin, Strategy, Similar, and Metaplanet, the price now. The suggestions for the peak: late August, early October, July, into this month, and Metaplanet. If you use the shorter data series now, but if you use the full Tokyo price series in October, and the Bitcoin price 2 weeks prior is not that high. It's 124K, consistent with this idea that bubbles are shrinking and that entropy is moving out to smaller scale structures spread out more broadly. Master has a lot of headroom to 700 or above, similar a little bit up to 51, Metaplanet from 12 to 16. If you look at the largest 15 Bitcoin treasury companies, I would submit that right now only 5 of them are truly in that category. In other words, the miners are not, Tesla is not, because it's such a small percentage. The same is true for Coinbase and Block. So the ones that are pure plays are MicroStrategy, XXI, CEP once it gets rolling, which should be pretty quickly, Metaplanet, and Similar Scientific. Sorry, that's only four companies right now. Amongst the miners, Mara seems the most likely to try to get into that Bitcoin treasury space. Okay, that's it. Thank you.
Very good. I love it. Thank you so much. Okay. So what to talk? Let me see if I can make this bigger. One day I'm going to learn how you do it. I'm still struggling with this. I don't know why. But this should be a little bit bigger. Let me see if I can make this smaller. No. What about this? Does it look better? No.
That's good. That's good.
This is good. All right. I don't see the screen, but it's fine. Anyway, so I thought we were not going to talk about stock to flow ever again. And then this guy, Brian Romeo, I don't know how to pronounce his name. He's supposed to be, I'm going to, I never lie. And so I'm going to admit, I don't know this guy. I look him up, and he's supposed to be a relatively well-known internet celebrity. I did a little bit of research on him. He talks about AI and technology and stuff like that. I know, so it's, evidently he likes Bitcoin too, and there are a lot of people that follow him. He has hundreds of thousands of people following him. And when you are in a position like that, and you're trying to educate people about Bitcoin, or at least comment on Bitcoin, it's good that it's important that you give the right information, And I was almost shocked by this post, because what is he trying to say? Is he joking? Because he's saying it's outstanding and robustly accurate. It looks almost like he's trolling people, because you right now, if you see the model is the gray thing, right? The gray tell us that right now Bitcoin should be $500,000 at a minimum, and this is after he, Plan B, the author of the stock to flow model, adjusted it by a factor of 2, because early post that he made, he was actually projecting $1 million for this cycle. And it's important to understand there are a lot of things, right? Say, what more do you need to know? A lot. You need to know a lot, because most people don't understand. They like this colorful graph. There are all these nice little big dots. And I heard the joke one time. People say, as the model becomes less and less accurate, the dots are becoming bigger and bigger. but they are colorful and people like it because I don't know what. They think there is some kind of pattern there that is supposed to represent Bitcoin. But one of the things that there are a lot of things that people don't understand. One of the things they don't understand is that if you study the model, and I think at this point I know the model better than Plan B. I know it sounds arrogant, but actually did so many tests, I studied so much, I push it in so many different ways that I do understand it better than Plan B. And it's worrisome because Plan B himself, if he really understood his model, he will do a retraction. He will say, look, I tried, I did an attempt, and there is fine. It's fine. It's fine to do that. It's fine to explore things, trying to go deeper, etc. But then doing this in a scientific way, that is the only way that is meaningful to do it, is also to admit when you are wrong. If you are wrong and your model, and it's not just how well is representing the behavior of Bitcoin, but also the ideas behind, right? If you are wrong and there is some problems with it, then you should admit it and tell people. It's important. And you will be respected anyway because it's fine. It's fine to explore ideas. You don't always get, to points only because you're right. Even just attempting and trying to explore, it's improving our understanding of these things. But anyway, so one of the things that I was saying people don't understand is that the value of this flat line here, it's supposed to be an average, right? It's an average. It's not the top. It's for sure not the top, right? Even the average. The average of what, right? It's supposed to be an average because when you do the fitting, you have this clustering of data points when you represent stock to flow versus the price, and when you are fitting, and he's trying to fit. Is another thing that many people don't know. There is a power law inside the modeling of stock to flow. It's actually a type of power law fitting of the data, but he's trying to fit things that are not behaving like power law. Stock to flow, it's deterministic. There is actually a formula. There is a little bit of variation in between the halving because the block time is now fixed, and so it can change a little bit, but roughly it's somehow constant during the halvings, right? So it's programmatic. It's a programmatic equation, and we can calculate this equation ahead of time. And the main thing about the evolution of stock to flow, that it jumps by a factor of 2 every 4 years. And if you know anything about math, any process that increases by a particular amount over time at fixed period of time tends to be an exponential over the long time. It's in fact almost a definition of what an exponential is. And so I don't know why he's trying to fit it as a power law. The only reason I can imagine is that he saw, and in fact, I talked with Plan B, kind of confirmed this, that he saw my, my post, my initial post in 2018 on the power law, and he was puzzled by that, and he was trying to find a causative process that could create the power law. At that time, I didn't know myself what was the causative process. Now we know that has to do with the growth of Bitcoin, with the adoption of Bitcoin. And so he proposed stock to flow. Stock to flow was mentioned by Seyfedin in the Bitcoin standard. And so, it seemed like an interesting idea to link the concept, because in the Bitcoin standard, it's just mentioned as a high-level concept. It's not mentioned as a parameter to describe the behavior of Bitcoin. And he did this step, okay? So as an explorative idea, could have been also okay. But now we know that it doesn't work. It doesn't work for many different reasons. The first one, look at this. How can you say that this is robust, outstanding and vastly accurate when we are around 100,000 and the average price is supposed to be 500,000. Average means that we need to go much higher than that, given that we are 100,000 now, to actually get that. And the cycle, okay, it doesn't have a lot of room for that. We will have to go much higher than $1 million in the future. And you can make a different. Really, if you take seriously the model at a face value, right? The jump should produce that change in price almost immediately. Now, you could say realistically, well, it does take some time for the market to adapt, right? Because the entire idea is that there is a shock. Shock means fast, a shock in the availability of Bitcoin, the shock in supply. The shock in supply should produce a change in price. If it's not immediate, the model says immediate, the literal interpretation of a model. But if you want to give some room to the market to adapt, you will expect the price to adapt to this new price very quickly. And in fact, that could be an interpretation if you take it seriously, but it's nonsense. If nonsense goes deeper, you can see that in the previous cases, right, the price reached this plateau pretty quickly. Here we are still below, and a lot of time has passed since halving. So it's clear that something is really wrong at this particular time. But it goes deeper than that. I show this picture because he has actually Einstein writing some equations. So he should actually like physics, right? And how physics argument. One of the things I'm trying to explain all the time, that independently of the performance of a model, it's a model that is flawed conceptually. It's flawed at its roots. What did I do here? I tried to do so many different ways. One way, I have this article that you can go and read on my Medium. I have a bunch of articles on my Medium. I took soccer prices. So the World Cup of soccer happens every 4 years. And if you look at the last several World Cup, they increase the amount that is given to the winning team. So I took that sequence and the ratio of these changes in the World Cup prices, and given that they are happening for years, they kind of align, not exactly, right, not the time, but at least the distance between the events. It's 4 years, so it looks like the halving, right, in that case. And they made a model of Bitcoin price using these prices. So if it works with soccer prices, it is absurd. It means there is something wrong. And you know what is wrong? Is that any time there is a jump like this, you will create a sense of temporal progression. Basically, it becomes a sequence that goes up in time. But it goes up in time only at one single event. It's a ridiculous model because, of course, that is not going to represent what happens with Bitcoin, right? In fact, I did here. If you are not convinced by the soccer prices, I did here. I created some kind of a random price action. Okay, there are no bubbles here. It's actually a good thing because the bubble creates some confusion. Here is simply, basically I choose a power law, but you could choose anything. Okay, and it's growing in time. There is noise, right? It's just a random sequence of numbers. And then at random times, I created this other model that is supposed to represent stock to flow that jumps by a factor of 2. But I choose a random time to show you that it's not even essential for these jumps to be equally spaced. They can be at any time, including equally spaced. They can happen at any time. And notice what happened. I create 2 completely independent sequence, and I create a model, the red line, that looks very much like SWF, that follows. You will be very impressed and say, wow, this model follows very nicely this blue curve. It seems to trace overall the trajectory and kind of stay, close to the value of these prices. Right now, you say, well, what happened in the middle? Yeah, exactly. What happened in the middle? That we should ask that question, but we should ask that question also for S2F model, and nobody ever asked the question why the model says the price is flat. Okay, I asked that question myself today. Few people try to answer, and there is one simple answer that I will give you in a moment, but it's a very fundamental question. Why the model tells me that the price should be flat in between these halving, these arbitrary invented halvings, but it's the same answer that we get here from this real, supposed real stock to flow model. I will tell you in a moment. But something worse, right? So what did I do here? I say, now I go back and I do the same model, but to make it a little bit more similar to the real stock to flow, I do the halving at precise time. Here I did it every year. I did it every year to get more data, but it doesn't matter. I could do it every 4 years. I can do it anytime. The same rule, right? I create some kind of fake S2F where the S2F jumps by a factor of 2 every year. I have this sequence. These dots represents where the jump happened, and they are drawn on top of the price because I'm showing what is the price at the time of jump. Now, the green line, what is the difference between this green line and red line? The green line, I use only 4 data points. Okay, that is basically what he used up to last cycle. He used only 4 data points. And you say, well, wait a second, S2F, it's a continuous function, right? It can be also calculated between halving. Yes, but it's mostly flat during these times, okay? And so I use only 4 data points. Notice, forget about the continuation of a green line, right? Go from here to there. That are the first, so put an end or something, cover it, and look at the first 4 points, right? You see how the green line comes very, very close to the blue line? It seems to do a very good job in tracking the price, right? Well, what if I add more points, right? So I will have to, using this, I'm going to calculate, because the entire idea is that this is what Plan B does. It calculates this quantity S2F, and then the price, and then it takes the log of price and the log of S2F, and it plots some kind of a straight line. Again, why did he do that? I think simply because he was inspired by the log model and introduced this quantity instead of time itself, because he thought that this quantity could give like a mechanism, to explain why we have a power law in the first place. He didn't realize that this quantity is an exponential, so the fitting is not going to be very good. And you kind of forces, you can shoe orning this fit, but the problem with that is that is another fit, meaning that by the time you introduce a new data points, you will have to recalculate the entire fitting. This is why if you keep the variables as in the previous fitting, you will see a deviation. You see the next cycle, you see how the green line, this is exactly what we are observing right now. There is a deviation keeping the parameter the same from the blue line, and the deviation becomes worse and worse. If we are jumping to the next cycles and we are going to plot S2F, how S2F is going to look like, the deviation will look worse and worse and worse in time. And notice how this green line, it's basically a straight line, right? It goes up in, like a stairs, but notice how it looks straight overall. It looks straight overall because in a log linear chart like this, where I plot the log of a price and the keep time linear, we repeated this maybe a million times. Anything that looks like a straight line is an exponential. It's clearly an exponential, and you cannot model something that bends like Bitcoin, because I use like a power law model for the blue line here, because it's 2 different type of functional forms. One is a power law with diminishing returns, and the other one is with constant returns that is an exponential. So this green line could never do a good job in, if you keep the parameters the same, in tracking the blue line. Now the red line, what is a red line? Well, now I'm using all these points that are many more points, right? I'm adding 4 more points, and I recalculate the parameters. And again, it does a kind of a good job in the sense that, like the last step here comes relatively close to the price. The middle one don't do a very good job because as you add more and more data points, the divergence, because again, you're trying to fit a power law with an exponential. But you see, the red line is for sure a better model than the green line. Well, because I recalculated the parameters, and this is what Plan B will have to do. He did it already, right? 2 cycles ago, he did it by basically saying, oh, I did some mistake. This is why he has this factor of 2. He had to recalculate everything, and he kind of blamed it to China. He said, oh, it's because China banned mining, etc., right? He cannot continue to do this. This is why he did an update for this cycle, because his game will be discovered. He will have to update every time, and he kind of, if he did that, he will get a kind of equivalent of a red model. But it will be still worse and worse, but not as bad and clearly bad as the green line. And this is what they did, right? Notice, like the final model uses an exponent that is 2.45. The first model uses a 4.42 exponent. So here I'm calculating the slope of the power law that is using to create the model. This forced power law, it's not a natural power law. You can always ask the algorithm, try to find a power law through this data. The algorithm will try to do its best, and it's going to give you a power law, even if a power law is not a good fit for your model. But the price you pay, that every time you add more data points, you will have to change that slope. And here is the y-intercept. And notice it's not a small change or a small adjustment. It's a big factor. We go all the way from 4.5 to, whenever I add more data point, 6 more data points, the exponent now is 2.5. So basically, this is what he will have to do, is to change radically his model. You don't get that with the power law. The power law has been consistent when people have done this type of test over and over and over again. If you use the parameters that I calculated 8 years ago, when I came up, 6 years ago, when I came up with the model, 2018, 7 years ago, basically, when I came up with the power law in time model, it will still work today. You will not have to change, or maybe make a small little adjustment as you get more data, but nothing like this. And that is another very strong evidence of how terrible this model is. Okay, and this is instead of a power law. These values, see, because here we don't have all the problems that the S2F model has. We are not claiming there is a correlation between time and price. We are just simply using the proper way of using the log space to say, well, if a price was characterized by a power law, it should look like a straight line over a long period of time. It doesn't look like a straight line here. It looks bent. An exponential will look like a straight line here. It's a log linear scale, right? But a power law will look like a straight line in this graph. And it does, right? Even if there are oscillations. And so this is the proper way of doing it. This is not the proper way of doing it. And you can see how flawed this model is. Not even in terms of how well it's doing, but conceptually. It's really the wrong model. There are very strong conceptual mistakes in how this model is designed. Anyway, this is I don't know. I know that this will not be the last word. Probably we'll have to go back to this one day. I don't know. I don't know when this is like a vampire. It never dies. It's a model that never dies. Anyway, do you want to comment something?
Yeah, a couple of comments. One is a very simple one. As long as it's a cube power law, as you go from one halving to the next, the ratio of stock to flow is converging on 2. Right now it's 2.14, and at the next one it'll be 2.07. So it's basically already converged to 2. Cubed is 8. That's 68% compound annual growth, a factor of 8. So it has to do 68% compounded annual growth from here to the end of the century. It's already clearly breaking down, and it's just going to look worse and worse as time goes on, because we know we're at 42% growth and next year 39, et cetera. So that's the first comment. The second one is the fundamental premise of this is flawed, because the fundamental premise was that decreasing supply would push up price. But in fact, the decreasing supply is over. We're already at 0.8%. It's not changing. It doesn't matter. The amount of Bitcoin that's being purchased is much, much greater than the amount that's being minted. The amount that's being minted is already a second order effect. So what determines the price of Bitcoin? What determines the price is how much people can afford to pay or are willing to pay. That's it. And, that is a function, yes, of people entering the network, but it's also a function of people who are in the network deepening their commitment. So it's a combination of attracting more treasury companies, for example, adopting this strategy, and 2, those treasury companies increasing their commitment by buying more and more Bitcoin.
Yeah.
As one category. So it's not the supply, it is the desire to own Bitcoin that's determining the price.
And you will say, well, that then is demand. It's different from demand, because demand, it seems like a semantic discussion. It's not, because it's really concept. It's really fundamental ideas. Adoption is different from demand, because adoption means that you are embracing the technology, you're embracing the concept. In this case, it's even beyond being just a technology. It's a lifestyle. It's a worldview. In a sense, it's almost like you are becoming a member of a religion or something like that, right? I know it sounds bad for the people that are not religious, but I'm saying that it's something that requires much more commitment, understanding, changes in decision making, and so on. It's a much deeper process than just demand. So demand doesn't explain these. For example, doesn't explain how come we have the square. So that we have a model, right, of how adoption grows, that is the cube of time, if you look at addresses. And then the price reacts to the square of this adoption. That is not easily explained with a simple supply demand model. I never saw anybody show me that you could recover that. Now, one could do something like that with S2F. I'm trying to kind of still man this model that it's kind of a waste of time. But one of the fundamental way to go from an exponential to a power law is to introduce some kind of 1/time component. That is really, if you look at how the change in the price happens, or the fundamental parameters of the model happen, is that it's proportional to whatever quantity you're measuring. Like, for example, if you're interested in time, right, you're saying, the change is, let's say you were looking at the relationship between price and addresses, right, or price and S2F, or whatever. Addresses is in our model, S2F is in this model. Then the price will be, the change in price will be proportional to whatever SF is of the addresses are, right, to how many people that are already joined the network, of the value of S2F. What is missing to make it a power law is a 1/time factor. And you could introduce that factor by saying, well, the response to S2F, but the change in S2F, it goes down in time. It's not as strong as in the beginning. The problem with that is is the other component that I mentioned about. It's so characteristic that you can see it is evident in this model, is that this model predicts flat behavior in between the halvings. Do you know what that means? No correlation. It means that there is no correlation with this quantity S2F and the price. The only correlation is a trivial one given by the jump. And the jump, we need actually to demonstrate that that jump has anything to do with the price change. And because any jump can do it that, right? Like in this case, these jumps are completely, they have nothing to do with the price because I made them up. They cannot, right? They are two independent sequences. There is no any link. I didn't link the change in price here to this jump in S2F. So, and you can see, I can still recreate a model that reproduces the characteristic of S2F. It is to track the price, at least roughly in the beginning. So it's a trivial model. You can recreate. This is why I use soccer prices. This is why I was able to take random things. I took on a certain point, I took the price of Ethereum and I correlated to the jump in S2F for Bitcoin. And I did the other way around. I did all kind of crazy things, and you will still get a model like that. The reason that is flat means that there is no correlation. And look what happens. This is something that we mentioned so many times. Actually, if you look at the core of a power law, that is these 2 years where, so if you eliminate the bubbles, the bubble usually lasts 1 year up, 1 year down. So if you eliminate the bubble and you keep what is left, it's basically 2 years of data. In that 2 years of data that is in between the halving, we grow perfectly as a power law in a way that is almost scary. Me and Stephen have shown this so many times. If we don't show you the bubble and we show you just what we call the core power law, that is all the data that are below kind of the middle line, right? There are more sophisticated ways of doing it, but that is the core power law, what is in between the support line and the middle, the mean behavior, right? Shown by the power law. That region, it's perfectly correlated with the power law. The deviations are very small, and the price grows. It grows with the cube of time. And S2F is flat during that time. So that shows there is no correlation. S2F cannot explain what happened in these times, in these 2 years. So that is more than basically 50% of the data. It cannot explain what happened in the 50% of the data. It should not be flat. This is a very strong warning sign that something is wrong with this model, because you can see very well that, imagine, that we had bubbles here 50% of the time, and the other 50% we didn't have bubbles. In fact, we can go to the real model and the real price. Well, Plan B will dismiss these times when we go up towards the flat times. But if you actually plotted these in a log graph, in these times, these red dots, almost, up to basically the top. So that if you exclude the bubble themselves, the data that is remaining, so what he will call mount, so actually will be more like the blue dots. The blue dots here, the blue dots, and maybe up to maybe the red dot, the blue and red dots. The blue and red dots is about 2 years, and these blue and red dots that make almost 50% of the data, they grow as a power law. So what model will you prefer? A model that perfectly tells you what happened in at least 2 years of the data, and then it also tells you what happened during the bubble, because what happens after you go up and then down, you go back to the power law. So, in average, even during the bubbles, you get power law behavior. And you can show it. Another way of showing it is taking Fourier moving average of the data, and you can see that the power law and the moving average are on top of each other. So this model doesn't explain what happened in between the halvings. And it does a very bad job at explaining what happened during the halving, because that sudden jump that we see, it's an artifact. It's an artifact of forcing these crazy fit, and you can reproduce it with artificial data. So it's spurious. You cannot say has anything to do with what the reaction of a price due to the reduction in production of coins. You have to demonstrate that. This graph doesn't demonstrate the fact that they seem to, like in this green line, they seem to follow the price. That is not a demonstration of nothing, because I can do it with random data points. I hope you understand, guys, what I'm trying to say. If you have something that, imagine you have a device, right? Another way of understanding is this. Imagine you have a device, a medical device, and this device, you put a drop of blood, and it tells you, oh, I detect human, and this human has cancer. And you say, whoa, I'm worried, and you're thinking this machine works, right? I'm worried, right? This person is supposed to have cancer. Well, say, well, let me test with something else. And then you put a drop of blood, and this is a perfectly healthy person. You have other way of testing. There is no cancer in this person. And you put it and say, I detect a human and it has cancer. I say, something is wrong with this machine. Then you put another drop of blood, and it's a pig. And the machine says, it's a human being and it has cancer. Like at this point, you throw the machine in the garbage. You think this machine tells me basically the same thing, no matter what my input is. It will be a terrible machine. In fact, right, there was a case at Terranos where they got in trouble because their machine basically was doing kind of like that. You need to be able to show that this works only when there is a real correlation between S to F and the price. And for sure, this method doesn't do that. You can reproduce the same result with random data. So it's a garbage method, conceptually. The reason why this doesn't apply to the power law is because time has a unique, that is the beauty of having a model of works in time, because time is a spatial variable. We are not saying that price is in any meaningful way correlated to time, where actually time is causative of price, right? It will mean nothing. We are just saying that taking a log-log graph shows the scaling behavior, that the price scales in time. Okay, the scale of price and scale of time are related by a simple relationship. It is a linear relationship. It's a completely different approach, and is a continuous approach. It doesn't rely on clusters. It doesn't rely on jumps. That this gives this false directionality in time. It's a completely different way of doing this. Now, I want to add something for completeness and transparency. When we show graphs in the log-log space of price versus addresses, that one has some of the limitations of trying to find correlation between two variables. So one has to be a little bit careful. The reason why, again, we overcome that problem, one, that model is also not jumpy. That is a good thing. And also, there is a much more robust logic in causative logic, and say, look, there are addresses that are growing time. They seem to grow with this power law. These are also, like, if you start to put everything in the framework of networks, we have a lot of independent evidence that networks, the links in the networks and the net in the networks grow as power laws. And then you say, wow, if you're thinking about addresses, it's kind of expected that they grow as a power law. The internet grows as a power law, and it grows with an exponent that is very close to Bitcoin. See, you're starting to build a case of multiple layers of evidence. So it's not, if it is, you're reducing the possibility that this relationship between addresses and price is spurious, because you have so many different layers of evidence. And so, yeah, I don't know, it seemed cool to people because many people told me, I understand stock to flow. Try to understand stock to flow. It's actually per se as a quantity is even kind of stupid quantity to start with, So I don't know why it became so popular, and it's even more mysterious why it's still popular now. I don't get it, 900 people saying, yeah, I like it. What do you like? It's so weird. I don't know. And any final words on this?
No, nothing to add. It's dustbin of history time, and I think we should move on to the questions.
Okay. So we have this question. We discussed this, right? For example, um, I had like an entire discussion on this last time. For example, we had another discussion about M2, but basically, if you look at directionality, if you're focusing, if you relax the idea that every twist and turns of M2 is predictive of what the price does, then yes, you can say there is a relatively strong correlation between M2 and BTC price that is directional. And some of the major peaks and bottoms and twists in the price seem to at least directionally correlate with between M2 and price. You have to add a delay, and in fact, you can trace different delays and see how well it works. This correlation. You can do different tests to measure the correlation, and 84 days, it's a good quantity. It's not, again, don't take it like why 84 versus 85. It's nonsense, right? There is no a precise date, a number of days it works. It's a rough estimate. It's an average. You want to add anything to this?
Yeah, it's roughly been shown by Giovanni, Michael Howell, myself. 10 to 12 weeks seems to be the centroid for the lag there. We call this Granger causality, and it's useful to look at the global M2, not just the US M2, or you can look at the M3, the OECD M3. It's similar.
Okay, I'm going to look. We have several other questions, like this one. At what price the Bitcoin avalanche start? I feel like we're being stuck in this range for so long, and we all need this one final clap for it to start. Do you want to comment on this?
I don't know. An avalanche is in a collapse.
We are all looking and watching, like this log periodic power law. It's a powerful tool that should be kind of predictive of some major resetting. The only problem, like Stephen explained, it's a very sensitive tool. It's all probability, right? It's telling you, oh, there is like right now, Stephen tell us, given the data, how it looks like now, it seems that we are going to have some kind of major correction, and the correction is downwards around end of August for Bitcoin. As we come closer to that data, we will do update. Maybe we can do it every couple of episodes or something like that. And that, two things will happen. It's possible that critical dates start to shift to farther away dates as we get more data to basically confirm the pattern. Or the pattern is confirmed. That is one of the things that actually, one of it, when you run these algos, one of the way to determine where the critical event is that as you do this calculation over and over again, there is consistency between the different calculations. So if we see this consistency, then that date becomes more and more probable, because everything is, we're trying to predict the future, right? And the only way you can do it, is in a probabilistic fashion. You can say it's like weather. You can say there is a 50% of chance of rain tomorrow. It's a 70%. Even when I tell you 90%, it doesn't mean that it's going to rain. It's just very likely that it's going to rain, but not 100%.
The liquidity backdrop is improved, and with the delay we just talked about, now would be a reasonable timing. We had poked up into bubble space in dollar terms late last year. We've clearly got to break through to another new high. If we want to break through relative to gold, then we should get to 40 ounces of gold. So that would be north of 130,000. So, we'd like to see breakout above, clearly above 110, but then above 120 to, see this next little wave of what we showed in this log periodic model.
And what natural phenomena can Bitcoin have an analogy to, like earthquake, avalanches? You can go ahead and answer.
Well, the earthquake analogy is this log periodic power law, which talks about the bubbles. So there is an analogy to there are power law features, particularly in the tails of those things. So in broad speaking, but earthquakes only tend to go one down, not up, right? Avalanches the same way, which was why I paused on the prior question. This is the bubble aspect comes from the herding behavior of traders, so that is a natural phenomena. It's a natural social phenomena. It's the way people behave, and they have behaved that way in stock markets for centuries.
Now, we repeat over and over. The main physics analogy is networks, because networks actually are studied as physical systems. So that is the overall trajectory, right? The overall trajectory, all the characteristics. You can go to the detail of saying addresses are nodes. There are links between people that are then expressed by the price, because according to Metcalfe theory, the value of a network should be proportional to the number of links, and we see this because there is a non-linear relationship between price and addresses. That is exactly what you will expect from a network. So there are many pieces of evidence. The overall behavior is network-like. Now, if you focus not just on bubble, because bubbles, the big bubbles that we see, probably these are just the things that we pay attention to, but there are similar behaviors at all the different scales. So it's almost like you have two overlaying type of physics. One is, and Stephen has explained it very well. He has this terminology where he calls the more power law-like behavior the core power law, and then he calls all the other type of behavior, he calls it turbulent flow. So a turbulent flow is another analogy. Look, analogies, even in physics, when we say, the oscillation of a star look like a spring, because we literally use a spring little model, or, when people found quantum mechanics, because we had this toy model of little spring representing the atoms that were attached to the solid, of a matter that we are studying, like a metal, for example. And that model didn't work because it was supposed to be quantized. But, people use like little toy models, and then analogy at a certain point break down, right? And so you have to use many different analogy, understand where the analogy can be applied, where it breaks, where it doesn't hold anymore. So I will say mostly that we have two different type of behavior that kind of work together. One is the overall growth that is very organized, very orderly, and it can be explained with the network, the physics of network. And then we have this more, the word is criticality. We have these critical behaviors that are associated with the daily changes in price, with the bubbles, with bull runs, etc., with behaviors that deviate from this long-term trajectory. And that is more similar to this entire field of study called criticality, critical phenomena. So that is how I will answer that question.
Yeah, one more is viral spread, which is also a network. And, I think we're seeing the virus happen right now with these Bitcoin treasury companies, right? That's kind of a viral phenomenon that's going on, and the rapid adoption, and they're racing with each other to, invade the body of investment capital and bring it over to them. Yeah.
So, and again, he's asking a lot of questions, but it's good. Uh, so he's saying this. I think he thinks that I believe in cycle, you don't believe in cycles. Is that the case?
Yeah, I think that's kind of true. I think I'm less of a believer, shall we say, in cycles. And I think the cycles are breaking down. I think what I just showed you on entropy is about cycles breaking down. So I'm not convinced that, well, I am convinced that the cycles are getting weaker and that the bubbles are decaying. And Giovanni agrees with me on that. And I'm not sure that we're going to get another cycle. The entropy is being drained into other structures, not necessarily well-formed bubbles. But I don't know yet. It could go either way.
Yeah. So I don't disagree with that. The only thing maybe I add is that humans tend to be cyclic, and there are many cycles that were existing before Bitcoin, and people have followed them for microeconomic cycles. So it actually will be really surprising if we don't see any cyclical behavior in Bitcoin at all. What will be different probably, and I don't see any disagreement between me and Stephen there, is how strong these cycles are. Before Bitcoin, cycles were crazy, right? The first ones, we went 10 pair away from the power law. So, and the extraordinary thing was that we went back to the power law. We didn't break the power law overall trajectory. Had this crazy deviation that could have broke that overall trajectory. And instead, he wanted to correct, and he corrected almost by eliminating whatever deviation and compensating for it. That is extraordinary. So we are going to see less and less crazy behavior, but I don't see. It would be surprising if there is no cyclic behavior at all. That Bitcoin, we see. We have different scenarios. One scenario could be that we simply follow the power law and we see some deviation from that, but nothing that you will call like a peak or a bottom or whatever. Or we still have some level of cycle, with certain very precise tops and bottoms, but they are faint. They are much weaker than before. So we will see by the end of this year, we will have some more data to understand which one of these scenarios we are following. Do you agree with that, Stephen?
Yeah, I generally do. There could have been a shift between the halving-driven cycles, which could have been just largely psychological, not really stock to flow, but just the psychology around the halvings. And of course, there was big supply impact for the first couple towards more things that are liquidity-driven and macroeconomic driven. And I've shown that, when you get liquidity a certain threshold, that can be a trigger for a bubble. So the nature of the cycles may have changed, and that also changes the periodicity.
And we have some questions like forest grow or other phenomena. There are many phenomena that behave in nature that the final result is a power law. And so there are plenty of these phenomena, right? When I make my usual presentation, I show, and Stephen show the same, like almost basically the majority, I will not say all, but the majority of physical laws are power laws. Gravity is a power law, because anytime you see a power, right, in terms of gravity, for example, you have 1 over r squared. That is a power law. The intensity, how much light you get from an object that is hot goes with the temperature thought. That is a power law, and so on and so on. Now, there are phenomena that are more complex, and if you look at certain parameters, for example, I have a book here somewhere. I can pull it up. This book is entire, fractals, power laws, because they are similar concept. Fractals, power laws, um, and chaos, right? Fractals, chaos, and power laws. And there is at the end of a graph talking about forest, at the end of a book, they have an example, like a toy model. They have this example of a forest fire. Do you know this book, Stephen? You have
I
this
don't
book?
know.
You have an example. In fact, you can program it yourself. You can ask ChatGPT to write this code for you, and they are calculating. They are making. It's one of the things sometimes physicists like. We make like a little game and say, "Hey, these are the rules of the game." Right? Very simple rules that you have control, and then you run a simulation. Like here, we have certain rules of how what is needed to burn a particular tree in this fire, the spacing between the trees and so on. And what you get in the end, if you run the simulation, you have a graph. Let me see. For example, in this case is um, the time. So this is actually a graph like the power law in time, because you have time, the log of time. You see, every time you make a graph where you have maybe sometime I'm going to show this example. We can run it actually. The log of time versus how many trees actually are involved, are being burned. It's a power law. You get a power law. And so you get a lot of these phenomena that you can say, we use this term, we use the term universality when there are very different phenomena, like, okay, how many trees are burned in a forest fire? Like, you will think that has nothing to do with our city grows. Yeah, they do, because the mathematics that explain how these phenomena work as a function of time, for example, it's the same math. And this, for a physicist, means that the underlying mechanisms are very similar, even if the details are different. So you can make a long list of all these different. And yes, fractals is not exactly, but it's a related topic because it has to do with scale invariance. So when you have something that happens at many different levels and many different scales, we call it scale invariant. Fractal is one of the most fundamental property of fractals. Power laws are also scale invariant. In fact, power law is the only function that is scale invariant. There are no other functions. Like if you have write an equation in closed form where you have to use squares and sine, etc., you cannot find any other function that is scale invariant. Only power laws. So they are very special functions. And so same thing. Parallels between decentralized system, Bitcoin, and distributed system in astrophysics, such galaxy cluster. Yeah, this is actually something that it's more in the field of Stephen, because he actually has many different graphs where he shows this, right? He had like a different graph showing the different scaling properties of astrophysics phenomena.
Yeah. Well, for galaxy clusters, there are power laws in like the distribution of the masses of galaxies within clusters. It's complicated by the gravitational field being dominated by the dark matter. We also see, rich galaxy clusters have emission, thermal emission in the X-rays. They have high temperatures because of the depth of the gravitational well of all of the galaxies and the dark matter within the clusters. And that temperature, radiates a luminosity that goes as the fourth power because it's thermal, just as, Gio mentioned. I think the parallel in the decentralization, I'm not sure. I need to think about this more. The cosmic background radiation is extremely uniform. And so there, what we see is a power law for the distribution of the tiny density fluctuations, which are only 1 part in 100,000 that we see. So all of the structure that's emerged started from fluctuations that were only 10 parts in a million when the universe was only 400,000 years old, and that cosmic background radiation was was released. But the distribution of the scale also follows a power law. It's really, really tight.
And the reason why,
minus 0.97 or
yeah,
0.98. Yeah.
see, and the reason is because the scales that survives the different clustering and organizations that you see at different levels. The only one that survive, right? Because in the beginning, you have everything. Are the ones that can fit this scaling behavior, right? It's kind of almost, it's probably also associated with principle of conservation of energy, least least effort, optimization in because a system tends to optimize their energy distribution, right? So power laws are associated with all this phenomena. It's a question of survival, right? So only certain, like when you work a certain scale, there will be certain forces and certain push and pulls that determine what is the size of whatever structure you're looking at that is the most survivable of that particular scale, given that particular level of energy or time, reactions to phenomena, whatever. And this is why, you see different things working at different scales, like the relevant scales for galactic distances are galaxies, because that is are the more stable structures, and when you work at small scales, you will see smaller things like atoms or cells, and etc., etc. That is the proper scale for that particular type of forces that are interacting at distances and that time scales. So it's something that is now that is selected a priori. It's a process. They come up in processes that over time create the most stable structures.
Yeah, and one thing I would say in that vein is, and this does kind of get to the decentralization and distribution and so forth, is as these galaxy cluster form, first from these tiny density fluctuations, which, however, are self-gravitating. Their density is just above the critical density of the universe. So the overall universe expands. These slightly overdense are just enough the critical value that they can collapse, and then they can form stars and galaxies within. And we're now learning very early on, even within the first 300 million years, galaxy formation is now being seen with James Webb. But those systems undergo a relaxation process. And there's a lot of different physics involved. But over time, and this is a kind of an interesting analogy just coming to mind, over time, the cores get more compact. So the most massive galaxies, the giant ellipticals, collapse towards the core. And the outer layers of the cluster can kind of puff up, and it may even lose some galaxies, to the extragalactic medium. But they go through this dynamical relaxation process as they collapse, and then they have to cool. So in order to form galaxies, it has to be a lot of radiation. And this is what ordinary matter can do and dark matter cannot. So they go through these complex formation processes. They have this thermal radiation, and they also form black holes. There's a lot of things going on. There's feedback there. But there is this kind of relaxation process that they go through. And that's a little bit like distinguishing the core power law behavior and the fact that these bubbles are coming down in strength with time. That's a little bit like a dynamical relaxation.
Yeah, like a noise over a long period of time cancels out, right? And you see the signal. And these power laws tend to be the signal in systems that have many different things happening at different scales, many different forces, many different interactions, etc. Right? So this is why it's so relevant for Bitcoin, because you see all these behaviors happening at many different scales. Right now, we're having big companies, big organizations, big institutions coming in, and they act and work a scale that are irrelevant for an individual. And then you have also individuals. So, but you have all these different type of behaviors and things happening in the market, and they organize themselves as power laws. This is what happens everywhere at all, many, many different examples in nature. So there is a one-to-one relationship between these two things. Now, this other question is, I think, very interesting, even if I don't like the term scarcity, but I think I understand what we are
Yeah,
trying to ask here.
it converts unlimited energy, right? Because the hash rate keeps going up very rapidly. The energy has grown more modestly the last few years. It's about 21 gigawatts now. It is definitely a physical bridge between the energy economy and the information economy. It is in many ways, in multiple different ways. It is, it is the first truly digital asset that's grounded in real world energy. And of course, lots and lots of cryptography. I like to call it encapsulated energy. And so this is money that is grounded in energy. This is the first true energy money that was first called for by a Nobel Prize winning chemist in 1921 in a paper that he wrote about the idea of having virtual money, if you will, in the form of energy. And others have talked about it, including Bucky Fuller and so forth in the 1960s. Indeed, it's energy to bits.
Yeah.
It's really electrons to bits, but they're very special, highly encapsulated, time-chained bits.
One of the most important questions that we hear about Bitcoin is where Bitcoin gets its value, right? So I came up, it's just a model, of course, one could come up with equivalent principles, ideas, but I came up with what I call the value triad. There are three, it's basically like a stool with three legs. And if you take even one leg, the thing collapses. If you add one more leg, you add stuff that you don't need because it's all what you need. And one is the ledger. We have a perfect ledger where we keep all the transaction, etc. Per se, that thing is already incredibly valuable because imagine when we started to do accounting, double entry accounting, that is considered one of the most incredible breakthrough in the history of finance. And Bitcoin is doing that and better, right? So it's actually, you can call it even kind of almost triple entry accounting. So we have a fantastic ledger that is immutable, it cannot be changed, and so on. That is one of the legs. The other leg is a social network, right? Because all the property of Bitcoin, all this beautiful property, the fact that it continues to grow, that it has a non-linear response between price and addresses are all network properties. And the third one, I always say, it's the mining network, that is a separate network, that is the link between this relatively kind of abstract concept that we just mentioned and physical reality. It's really what grounds Bitcoin to physical reality, that proof of work. It's incredible because it introduces all these limitations that are, you will think that are limitations, but actually it's good to have limitation because it creates something physical and real in terms of computations, in terms of how much energy we use. So anytime that somebody says, oh, Bitcoin has no physical value, there is no, what is backed by? Well, it's backed by energy. It's backed by all these incredible quantity of energy that is necessary to run the system. And it's not like a liability. It's actually an asset. It's a good thing that there is a physical value that is associated with Bitcoin. Because when people associate physical value to gold, for example, right? What do they think? Oh, it's heavy. That is an ancient. It's actually an analog approximation of what the ideal money should be, because energy is much better, right? First of all, matter and energy are related to each other. So one could even calculate the weight, the physical weight from energy or whatever, but it's a much more important concept than weight itself, right? Because you have it has all the good thing of weight. For example, it's you cannot you cannot create energy from nothing, right? You need to have some process that transform energy from one form to another form, and it costs money to do that, um, or effort, or whatever you want to call it. But also, it doesn't have a limitation. Like you can move it relatively quickly from one place to another, and so on. So energy is much better physical, real concept or quantity to be associated with your money than mass, for example, or weight. So I always say the gold, it's instead of Bitcoin being a digital gold, is more the other way around. That the gold is a proxy; it's an analog proxy for Bitcoin, that is the ideal money. It's the best they could do until we had a digital way of expressing money, of creating money. But yeah, it needs to be linked. You need to have some kind of a bridge to reality. And then once you have that, it's natural that you have a bridge between what we call economy, right? All the companies that deal with the energy, create energy. The fact that a lot of electrical company are actually interested in working with mining company, because they offer, beside, they have a lot of useful aspects. For example, you can bring energy, electrical energy, to rural places, because the mining company can make some kind of agreement, arrangement, where we get cheap electricity, but they give some of electricity they buy free to the population. You can stabilize the grid. There are a lot of interesting synergies that, in fact, they could be perfect topics for our institute to study, and create, like, maybe prizes for people to explore and whatever. So there is a lot of interesting topics there. Do you want to add anything?
No, I would just say those three legs of the stool are exactly the three things that fiat currency is not, right? It's none of those things. And the other thing is that they're intertwined. These three legs are like intertwined in the overall Nakamoto consensus protocol. And it's because you have proof of work and because you have peer-to-peer that has no bank or government involved, that the adoption network grew. The adoption came about because having it created privately with no government involved, and having it's tied to real value of the electricity input and the value associated with the computers implementing the cryptography, the hashing. That security, that high level of security, is what gave people the initial confidence in it and growing confidence in it. And that's why the network has grown.
Right. And this is a big misconception, because, in fact, I'm going to write a bunch of essays. It's a lot of work, and this is why also we need an institute, because as time passes by, eventually we will have like a library of articles, etc., that people can read, because these are very interesting fundamental topic. And if Bitcoin is a point of reference in your life, you really want to explore this topic. You really want to understand it. You don't want to rely on fake models or weak ideas, etc. You want to make these as rigorous and as profound as possible, right? And so this idea of scarcity for me is very important, because I think people confuse it so much. But Stephen says something very fundamental, that is, the idea that many people associate with scarcity, for example, the fact that we cannot dilute the system, right, by a third-party intervention. That kind of, it's one of the things that people call scarcity, but it's not really. And so, yes, the fact that we have a finite amount of coin that is part of the first leg, the perfect ledger, It's part of a value proposition. Absolutely. Nobody is going to deny that ever. But the word scarcity is not really the right scarcity to describe that properly. Something much better and more profound, much more profound. Bitcoin, in a certain sense, doesn't need scarcity as understood by most people. It's some other property that the word scarcity doesn't describe properly.
Aristotle used a different word. He said intrinsic value.
Yeah, I like that word better.
Bitcoin has intrinsic value because of the nature of the process by which it is created.
Yeah.
If you had an algorithm that increased the supply gradually, it would still have a lot of value, right? Not as much, but it would still grow as a power law.
Yeah. I like that because we need to start to move away from negative concepts, right? Because scarcity also historically, if anything, has been associated with countries fighting over resources, etc. And we are insisting over and over, right, that Bitcoin supposedly is going to end the war or make them more difficult. It's you don't need to necessarily decide that by entering the Bitcoin system you're going to cooperate, but the result is the same. The result is Bitcoin behaves as a cooperative system, like it's a non zero sum game. It's not a zero sum game, it's a non zero sum game. And so when you talk about scarcity, you evoke all this concept, right? Competition, fighting over resources, and stuff like that. So I think we should move away from that concept and come up with something better. But yeah, the energy component is fundamental.
I've been saying for a long time, value. Bitcoin
Right.
converts energy into value.
Value, absolutely. Yeah, and value, if you think about, right, because the beauty of science is that it's grounded in reality, but it gives us direction. And that is one of the things that many times science kind of failed a little bit. In the beginning, no, because in fact, in the beginning, science was called natural philosophy. It was a form of philosophy that was grounded in nature, in reality. Okay, or you can call it reality philosophy or philosophy of reality. And philosophy is a beautiful word. It means the love for knowledge, right? And so all these things are becoming philosophical topics in the end, because if you think about, right, all what we do in life, it's about value of some kind, right? Some kind of hierarchy of value. The food that you eat, it's a form of value, right? Something that it's a necessity, but and then you build these hierarchies of value. And Bitcoin, it's an amazing thing because it's all about making this value quantifiable, and mathematical and real and objective. It's an objective way, the most objective way, because value, of course, it's also subjective, but it's the most objective measure of value that we have.
All meme coins and all altcoins that don't use proof of work have no intrinsic value.
Yeah, it's correct.
Yeah.
It's absolutely correct.
Yeah.
Okay, guys, and we actually answered this question before. Like, anytime you have a system that has some kind of scaling principles, right? So it's a very complicated topic, and I mean, not complicated topic. It's a complex topic. There are a lot of facets to it, but I suggest you to start to listen to this beautiful online lecture. It's called The Surprising Math of Cities Corporation. These concepts are being introduced there. And if you really want to go deep, then there is this beautiful book that is called Scale. I started to make a bunch of videos. Maybe sometime me and Stephen can do, we can alternate. Maybe once a month we can take, what, that could be actually an interesting way of doing our episode, Stephen. Maybe once a month, we can take a chapter from the book and discuss it. You can do half, I can do half, and it will be also basically an introduction to the book, to the concept, and they will give us some material to talk about, because we are trying to do all the time new research, new funding, but it's not easy, right? Research needs time, and that puts a lot of pressure on us. But we can dedicate at least one episode a month to discuss the book, and we can do a book review, and then maybe we can switch to other books. There are many other interesting books. There is another book that is really cool that is called How Nature Works, that also talks about all these critical phenomena, etc. That is also a great book. There is a book by Barabasi, that is the physicist that studied networks. I have it here. I could take books from my library. Where is it? Here, this book. It's called Linked by Barabasi. So if you want to understand networks, and these are very beautiful books because they're written by professionals, in fact, leaders in the field, and they go but there is not even an equation inside. If you don't like equations, it's mostly concepts, but you go really deep in understanding the concept by reading this book. And there are audible versions of this book that if you're busy, driving, you can listen to that. Anyway, guys, thank you so much for all the nice questions, and we will see you next week.
Thanks for joining.
Thank you, everybody.